Welcome to the December Market Thoughts video. My name is Maria Considine King, and I'm here with Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, the markets were very volatile in November. Was that volatility justified by the economic fundamentals?
We're actually seeing the economic fundamentals, at least in the U.S., continue to improve. Consumer spending has continued strong, housing has continued its recovery, autos have been particularly strong. So the fundamentals in the U.S. are actually quite good. What's driving the market volatility right now is politics. Politics and the fiscal cliff. That is what we're really seeing, a disconnect between consumers on one hand and business on the other. And what you're seeing is the volatility very closely tracks how the Congress is dealing with the fiscal cliff issue. Consequently, no, it's not really a fundamental issue at all. It's really a politically driven process.
The big question on people's minds is the fiscal cliff. What is it exactly?
The fiscal cliff is shorthand for a number of different things. Briefly, there are two components. There are tax increases and there are spending cuts. The tax increases compose about 2/3 of the total, okay? And the spending cuts are about 1/3. And the problem is those tax increases are largely going to happen regardless. There's a tremendous amount of discussion over the tax increases on the rich, whether they should go forward or not. But the reality is the tax increases that affect most people are going to happen regardless. There's a 2% payroll tax waiver that expires. That is going to happen. The tax increase that goes with the Obamacare Act, that is going to happen. So a lot of the tax increases are already built in, and that will have an economic effect going forward, as will the spending cuts.
Could this derail the recovery?
It certainly could. And the way to look at this is, first of all, the fiscal cliff doesn't seem to have affected consumer spending, but it has dramatically affected business behavior. Businesses are postponing hiring, they're postponing investment decisions. Businesses will not make commitments to do anything, pretty much, until this is resolved because they don't know what's going to happen. That is the missing piece of this recovery. Not only that, because the fiscal cliff cuts about 4% off GDP, which would be bad enough, but actually it's not a one-for-one relation. Tax increases, the multiplier is 2 to 3. Spending cuts, the multiplier is 1 to 2. So that 4% is actually going to have a larger impact on the economy if it goes away than the 4%. And when you're only growing at 2%, it's not tough math to figure that puts us into a heck of a recession.
Going into the new year, what should we be watching for?
We really need to, first of all, let's look at the real economy. We need to watch the housing market. That is going to be a critical component of what happens going forward. We need to keep an eye on auto sales. And by the way, they just came in very, very strongly at 4-year highs, I believe, the other day. These are both very strong components. We need to watch consumer spending. But all of those can be trumped by politics. What we're currently seeing right now is the negotiating process between the White House and Congress. That's a normal process. There's a certain amount of political theater going on. We can expect to see that continue, frankly, until the end of the year. But that is going to be largely the determinant of where we are 6 months from now economically.
Thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.